Let's wrap up the chapter by talking about repurchases. Probably 4 more videos, hopefully, to finish off this chapter. These conceptual chapters definitely go a little bit longer in terms of lecture, but I figure you probably don't have to go practice like you do quantitative problems, so it's probably a trade-off somewhere in there. But like I said, hopefully 4 more. I went to take a little break and watered my front flowers, so I'm ready to finish this off with you guys. So we have our definition there again of what is a stock repurchase. Same definition as before, just when a firm decides to go buy back some of the stock that it previously issued, and it's going to show up as treasury stock. And we know now that it's a way that we can distribute cash to our shareholders. It's an alternative, a more popular alternative, actually. So I don't even know if you can call it an alternative or if it's the main thing, and cash dividends are the alternative now, but that more firms rely on this to provide a return to shareholders than they do cash dividends. Specific reasons for repurchasing. Number 1, as an alternative to distributing cash as dividends, right? So if you don't want to declare a dividend and, force people to take it, that's one of the nice things about repurchases is it leaves the choice to the shareholder, right? If you declare a cash dividend, your shareholders have to take it. They can't opt out. Even if they enroll in something like a DRIP, which automatically reinvests the dividends for you back into the stock, you still pay taxes on the dividends, even if you automatically reinvest them in the stock, because the IRS is not going to let you get away from paying taxes. But it is just a straight up alternative, right? Number 2 there, reason for repurchase specifically, is it says to dispose of a one-time cash flow from an asset sale. So you sell off a division or you sell off a large asset that you're no longer using. And you're like, wow, that's a lot of cash. What you want to do? And you've already covered all your projects and you don't foresee, needing it for future projects. Well, you should distribute that money to shareholders. And one way you could do that, if you believe your stock is undervalued, right? We never want to repurchase overvalued stock. Is that we could go out and do a stock repurchase if we believe our stock is undervalued. It's also helpful when firms want to recapitalize, which just means they want to make a change to their capital structure. So let's say we used to be 70% debt and 30% equity, and I want to move to 90% debt and 10% equity for some reason. Well, I need to reduce the amount of equity I have, right? How do I do that? I go out and repurchase some stock. Is one way I could do it. And that would allow me to make not just, these little minor nudges in terms of shifting my capital structure, but a major, flip the switch kind of thing. And the 4th one there says to use when employees exercise stock options. And so a lot of times when employees go to exercise their stock options, which we know are popular in compensation plans, right, especially with higher level executives, you don't want to issue them new shares necessarily, because that is going to dilute the ownership of your current shareholders and, of course, their earnings. But if we do a stock repurchase and then we hold on to that stock as treasury stock, when employees go to exercise their options, we simply fulfill basically those options with those stocks that we repurchased basically from the open market previously. And so that way, the number of shares just goes back to the normal level, of before we did the stock repurchase. So the number of shares would dip when we would do the stock repurchase. And then when we would fulfill the employee stock options, it would go back to normal, quote unquote, normal levels. So that's another thing that stock repurchases can be specifically used for. Ways that we actually repurchase, there's 3 basic ways, and we won't go very deep into these because, you could have a whole chapter on a targeted repurchase. But basically, they can just go to the market. Just have a broker or a trustee acting on their behalf and just literally go buy and sell, well, in this case, buy the stock like anyone else would, right? That's it. They just go and start purchasing it. And typically, they people know that the company is doing these kind of things. These types of actions come with announcements. Now with this, the company has to be very careful. If I'm going repurchase stock, I got to get very, very careful I don't cause too much excess demand if I'm choosing this first option, right? Because I'm going into the market and I may be very, very large compared to like what a normal trading volume would be. I may be significant. And if I cause too much demand, I'm going to end up pushing up the stock price, right? So companies do have to be wary of this and make sure that their stock doesn't end up becoming overvalued in this process, right? We only want to repurchase when the stock is cheap, when it's undervalued. One way we can avoid doing that is what's called a tender offer. That allows stockholders to send in, or tender is where it comes from, shares in exchange for a specified price per share. So the company just says, hey, look, we're going to be willing to buy X amount of shares at X amount of dollars over the next 2 weeks. If you want to take us up on that deal, send us your shares, right? So it kind of bypasses like the market forces and just says like, this is the price we're paying for the stock. If you want to tender it into us, feel free. If it ends up having too much of a response, they'll just do it on a pro rata basis, right? So, they'll adjust everyone fairly to where you're still given a chance to send in a fair percentage of the amount of shares you want to send in. The last way they can do is that they can go purchase a block of shares from one large investor, or one large institution is more likely what it's going to be. So if we know there's one institution that holds a large amount of our shares, we may just go to them and personally have a negotiation of, look, we're going to buy all of the shares because we want to do a large repurchase, and this is how much we're willing to pay, right? And so you can imagine transaction costs are going to be the lowest in that last one, right? And probably the highest in the first one there. So yeah, that's our 3 basic ways we can do it. Go to the market, just buy it like normal. Be careful with running at the price. We can make a tender offer to where we just say, hey, we'll pay this price, send us your shares. Or we can go and do a negotiated bid in a in a targeted response, or what's called a block repurchase. That's it. So next thing then we want to talk about, now that we know basic reasons why we do repurchases and ways that we repurchase, is that what's the actual impact of like choosing dividends versus repurchases? Is there an actual difference in stock price? And if you want to glance down at the chart at the bottom, you'll see that there is. And so we want to figure out what's going on there, and that's what we'll do next. Then we'll look at advantages and disadvantages of repurchases, some conclusions about them, and then we'll summarize finally, again, one of these nice long chapters.